Key difference is back in 2008, we didn't have the magic cowbell. We didn't have money printing. So interest rates are a slow, blunt tool. Money printing is instantaneous. So I think everybody was shocked by what happened at COVID. They shut the entire world for 3 months. The market went down for precisely 4 weeks and then rocketed going forwards. Why did it rocket? Because if you deflate the price by the amount the balance sheet went, it was just debasement of currency. I don't see how you can have 2008 once you've got the money printer.
About a week ago, Real Vision founder and CEO Raoul tweeted about the importance of the global liquidity cycle on asset prices. In his post, Pal wrote, "We are only just starting the global liquidity cycle, and it already produced 50% gains in the NDX and 150% gains in Bitcoin in 2023. 2024 and 2025 are the years we should expect an acceleration in liquidity, according to the Everything Code." Let's see. This post summarizes Pal's Everything Code thesis, which primarily seeks to establish an interdependent connection between central banks' balance sheets, especially the Federal Reserve's, and asset prices. Pal believes the global economy hit a turning point that should have been completely catastrophic in 2008, but central banks came to the rescue to stop everything from falling apart. As a result, the fate of the global financial system. It will stay strong as long as central banks can print until a more lasting solution is found. Pal believes this solution will address demographics and productivity decline, the main reasons why we are in this mess to begin with. With the rapid development of robotics and artificial intelligence, Pal seems to think we have stumbled on that solution, and by 2030, the world will be significantly more productive so we can properly take on our massive debts. But that's still years away. The first part of Pal's thesis addresses more urgent concerns, especially currency debasement and inflation. According to the Real Vision CEO, investing is the only way to keep up with or outperform the rate of devaluation of the dollar and other fiat currencies. While most assets will at least help you keep up with the rate of devaluation, Pal believes only crypto and tech stocks will truly outperform. According to the former Goldman Sachs executive, choosing this simple strategy means you never have to worry about recessions or other forms of economic decline. As long as central banks can print, asset prices will keep appreciating, and crypto and tech will continue to lead the pack. During a recent interview with Crypto Banter, Pal, alongside macroeconomist Henrik Zeberg, discussed the merit of his thesis, specifically against Henrik's thesis about an impending recession in 2024. As we bring you clips from insightful discussion, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. You can also join the conversation by dropping your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and contributes to the channel's growth. Thanks, and enjoy the video.
So this is global liquidity from all the major central banks, the Fed, the BOJ, the PBOC, the ECB, and the Bank of England. And basically, they were all withdrawing liquidity, but I noticed that liquidity had bottomed in year-on-year measures and other forms back in, it actually started bottoming in June, which got me into starting to rebuy Ethereum in the lows there, and then fully confirmed the bottom to me in my measures in October, November. So that's when I really kind of loaded up in technology and the full crypto. And for me, that these are forecastable, readable cycles based around the debt refi cycle. So for me, that's why I've got a more extended view before a downturn than Henrik has, because I don't see any reason why it won't just continue, generally speaking, till 2025, the end of this perfect cycles we've been having since 2008. So this is the Fed balance sheet in black, and the red is 36 months forward of the current interest payments. What that's telling you is the interest payments are set to explode or are exploding because of the COVID payments 36 months ago, the COVID debt. And what we found, this is the shorter term chart, using the longer term chart since they started QE, basically all QE has been monetizing past debt. So after the 4-year cycle, they just monetize the debt, shove it on the balance sheet, start again. So it's been this endless 4-year cycle based around this. And we've got this ridiculous phase to come where they can't really manage the interest payments without doing something. Right? You can't have rates at 5%. or even 4% if you're looking at slightly longer, because the maths don't work, and they've got to keep issuing to pay all the interest of the 10 trillion or whatever they have to roll over the next year or two. So, for me, that's the liquidity cycle, and you do that, and assets go up because you're debasing the denominator, the currency. So what happens is when you issue debt, you've got a fixed interest rate that you've now pay, right?
Yes.
So 4 years ago, this was all done at nearly zero. So if they've gone from, let's say, 1% to 4%, right, that's a 300% increase in the cost of paying the interest alone.
There's no way they can afford it.
The numbers of the interest payments are so big now that interest payments are now larger than defense spending. It's bananas.
Okay, so what happens next? So how is the US getting out of this?
That's been my core thesis for this everything code cycle, is they've done the same thing every time. The economy slows down because rates have gone up and there's so much debt. So fine, the economy slows down a bit and they use it. It's the same time as the election cycle as well. It's all the same cycle. Bitcoin halving cycle, it's all the same time. They get interest rates down and they engineer some way of using the balance sheet. Who the hell knows how, what reason? But that's generally what they do. And that's why election years tend to be pretty good years, which is why this is why, and I'd love to hear your view, Henrik. That's why I still struggle to get bearish for 2025, because even if the economy slows in an election year, they'll just stimulate more. And that's the struggle I have, is that, if you have a blow off top and some, I've seen some of your stuff, like you could have a 1929 style thing. I'm like, I don't think you can, because they just print money and optically it debases the currency. So how do you get that?
Henrik's thesis, though also bullish in the short term, is more bearish in the longer term. Henrik cautions being too optimistic about liquidity and central banks' ability to keep things smooth, especially given how much debt they have amassed by doing that over the past 15 years. Henrik adds that there is currently a lot of weakness in the housing market, which is usually a major sign of an impending recession. According to the macroeconomist, the only reason the recession hasn't occurred yet is because of the strength of the U.S. labor market. However, he adds that all that is about to change. Henrik believes companies built up their capacity after the lockdowns because of the very generous stimulus packages and expectations of a full multi-year economic boom. However, the reality has not really met the expectations, and they are still sitting on their hands, awaiting stronger demand to put their full capacity to good use. In another 6 months, Henrik believes they will finally throw in the towel and begin laying off workers in droves. He adds that when the recession hits, central banks will pour in a lot of liquidity to avert disaster, but they will only worsen the situation and create a prolonged period of stagflation. Here's Pal's response to Henrik's thesis.
I look at the housing market, and year on year, the rate of change of housing is actually now stabilized and sort of rising with the forward-looking indicators for ISM. And also most of the interest payment charts, a lot of that is mortgages, and the mortgage stuff is fixed rates. So there's actually a very small amount of that seems to be an issue going forward. So I'm not overly concerned by that. When I look at the business cycle, I use the ISM survey, Institute of Supply Management. I've got that goes back to 1947, and you can use the Treasury survey that goes back to 1870. Works pretty well. Gives you a decent idea. So here's how I'm just using my recent GMI monthly, and I haven't got all the full economic charts in this, but basically there's a very nice cycle, which is the top chart in black, which is the ISM. And this is this everything code every 4-year cycle, or every 36 months. Now, when the ISM gets below 50, you're starting to look for a recession. It's been below 50 all year. Most of the forward-looking indicators were showing this all through 2022, that we should be slow now. Now, the question is do we get some other events that, ignoring the COVID, is there something that could create a weaker economic cycle than regular, considering the Fed are now stopping the rate rises? Now, they did that also in 2008, somebody might say. But the point being is, what is the systemic shock here that causes a freeze up of the collateral system that can't be solved by liquidity? So if I look at the forward-looking indicator just by using the ISM alone, just inverting it, because it's such a perfect cycle right now, we've been following this pattern all the way. So my idea of the business cycle, and we use financial conditions index and several hundred charts based around the business cycle, actually several thousand, is for us, the business cycle just gets stronger from here on in. That whether we got a recession or didn't get a recession, it was priced into growth assets last year in 2022, and in 2023 it got priced into stuff like the Russell 2000 and cyclicals, and I think most of it should continue higher. So I don't really see the evidence of it being a late cycle. That, to me, if I look at this chart, that looks like we finished the cycle. The forward-looking indicators, stuff like ISM new orders to inventories has been rising. That's always signaled the bottom. The new orders has signaled the bottom. So I'm pretty sanguine about the risk of something larger happening here that could derail the economy.
What you saw back into was absolutely, as you said, the Fed, I think they stopped the rate hiking cycle in 2006 already. And as you said, they tried to manufacture again, the whole business cycle. And what we saw there was that by the end of it, we really saw that it was the housing market, the deterioration. And I know we had speculation around that time in the housing market. But we also do have speculation today.
Yeah, but the key difference is back in 2008, we didn't have the magic cowbell. We didn't have money printing. So interest rates are a slow, blunt tool. Money printing is instantaneous. So I think everybody was shocked by what happened at COVID. They shut the entire world for 3 months. The market went down for precisely 4 weeks and then rocketed going forwards. Why did it rocket? Because if you deflate the price by the amount the balance sheet went, it was just debasement of currency. I don't see how you can have 2008 once you've got the money printer.
According to Powell, all hope is not lost, and there is still a high chance that we can continue coasting along without any serious repercussions for Americans and other countries with strong currencies. However, investing is still very important and compulsory for everyone who wishes to maintain their wealth and increase it over time. However, asset classes like bonds will not rise quickly enough to make up for inflation. Popular stock indexes like the S&P will do just fine, helping you to maintain wealth without increasing it, but cryptocurrencies remain the top choice. Only crypto and technology stocks will continue to outperform the rate of currency debasement. What are your thoughts on the video? Do you agree that AI and other fast-developing technological innovations present a solution to the world's massive debt problems? Please drop your thoughts, comments, and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.